what do we need to do to consider if the misstatements we've just identified above, the quantitative or the qualitative, are material? Well, first of all, for our quantitative, we determine amounts that helps us to consider if there is a material misstatement. And guys, you will remember in the planning stage, we did develop two materialities. We did a planning and we did a performance. And the planning was the materiality figure that we would accept for the financial statements in entirety. So it meant that this was the maximum amount the financials could be misstated. So anything that could be misstated in excess of that already shows the financials are misstated, because in entirety means when adding up all misstatements, it shouldn't exceed planning. We chose planning at that stage because we needed to have a maximum figure that we were working with so that we could then determine our minimum figure. Performance, which we actually used when auditing. And if we identified any misstatements above this, we kept a record. And if we identified misstatements below performance, we kind of ignored them because they weren't going to be significant for us. Okay, so this is why we've got to consider the two. So at a concluding stage, we now go and work out a final materiality. And all that is saying, if in the planning stage, when we calculated planning materiality, we didn't have the actual financial statement figures, because we started planning early, so we used budgeted figures, or we used prior year figures, or we used grossed up forecasted figures. Our planning was not based on the actual year-end figures, so we had to use what was available. But at the concluding stage, we have the actual figures. And so we will calculate a materiality based on those actual. So guys, it's the same calculation as the planning. It just differs with, we must now use the actual. We don't have a choice of which figures we are going to use. If, guys, in the planning stage we use the actual because they had them, then actual will equal planning. Okay, and then we don't have to consider a new final materiality. Our materiality would be the same in planning and final. It's only if we use different figures in planning that our final materiality will differ. So look, what final materiality is: the total amount of quantitative misstatements acceptable for those financial statements. Which means when you add up all the misstatements that we've picked up, they must not exceed that final materiality. If they do, the financials are materially misstated. Cool. So when we're looking at an amount, that amount would be greater than performance because those are the ones we kept track of. We need to look at it and say, does it exceed final materiality? If it does, it is materially misstated. Then we have to also consider all the misstatements in aggregate that are not adjusted, because essentially when we pick up a misstatement that on its own exceeds final, management must adjust, otherwise we already are going to qualify our opinion. So if they don't adjust, we add all of the misstatements that we picked up that were not adjusted and we compare them to final materiality. And if they exceed final materiality, once again, quantitative materially misstated. Okay, so when we get to evaluating our misstatements, you will see us put that into action. But just for you to consider now, when I see a misstatement, if it exceeds final materiality, it is materially misstated. That's our quantitative. When we look at qualitative, All we have to do is consider, would this be material to the users? So, would the non-compliance with IFRS be material? Would fraud be material? Would the effect of this misstatement on key ratios be material to users? And guys, it's subjective. So you might say yes, the marker might say no. And so often with qualitative, guys, I think it's important to really consider putting down both options. Yes, it is qualitative because it would impact on the users, or no, it's not. These are the different opinions. Okay, so a little bit more tricky with qualitative, but what I do want you to see here, guys, is you need to ignore the amount when you are assessing qualitative. So what do I mean? Final materiality is set at 50 million. That's your quantitative amount. You pick up that revenue is fraudulently misstated, and the amount is 5 million. It's not quantitatively, but it's qualitatively because of fraud. And irrespective of the amount, don't you think the users would want to know if management were acting fraudulently? Yes. So this would be qualitatively material. So I ignore the amount when I'm considering qualitative, and I only look at the amount when I am assessing quantitative. Okay, so here's our evaluation process. This is what you're going to do for any misstatement. You first need to determine, is it quantitative or qualitative? For quantitative, all you need to do is compare it to final materiality and say, it exceeds, it is, it doesn't exceed, it's not quantitative. For qualitative, I now need to go and look at the nature, and I need to consider, do I think the users would be affected by this? Based on that, I conclude yes or no. Irrespective of what the answer for one is, I still need to move on to step 2 and to categorize it as factual, judgmental, or projected. Each misstatement will meet one of these criteria, so I must put it down. Once I've done that, I then say, if it has been material, either quantitative or qualitative, it doesn't matter which way, I must ask them to adjust the financials because there is a material misstatement. They must correct it. If it is immaterial, which means it is less than final materiality, and it is not qualitative, then I go and add this misstatement to a list of misstatements that meet the same criteria. So I go and I make a schedule. How do I do that, guys? You literally draw up a table that goes like this. The misstatement, and here I would have to put the details. The effect on profit or loss, the effect on your assets, liabilities, and equity. And so, if the misstatement, like we said earlier, was revenue, let's consider that it wasn't a fraudulent misstatement, there was just a misstatement of 5 million, an error. So I've got my revenue of 5 million, error. I would say they need to debit revenue with the 5 million, and they need to credit the debtor, which is an asset, with the 5 million to make that correct. So I just go and put my journal entries in a schedule here, where I will now put all that are not qualitative, and their amount is less than final materiality. If it is qualitative, guys, it meets this criteria, it's material and they must adjust. If it is quantitative, it meets this criteria, it's material and they must adjust. Okay, so this is only for immaterial unadjusted. They don't need to adjust because it is not material at this point. Then the next step, if it was material and management make the adjustment, I must go and audit the adjustment. Remember, if it was not material, they needed to put it here in our schedule. So I take each of those and I say material, they must adjust, I go and audit the adjustment. Immaterial, put it on the schedule. So for each option, I've got work to do. And then my last step is to aggregate all those immaterial. So all those ones up here that we said were immaterial, less than final materiality and not qualitative that we need to put on the schedule, I need to go and create all my journals for the items and then add up the total of the effect for profit and loss, assets, liabilities and equity and compare each of these to final materiality. So the aggregates of uncorrected are compared to final materiality to make sure that none of those exceed final materiality. Because remember guys, when we go up to quantitative definition, we first needed to look at things individually and then we also had to determine if all the uncorrected, when added up, so the total exceed final materiality, we just need to put them into the correct aspects that they affect on the financials, profit and loss or assets, liabilities and equity. Okay, so now let's look at some of the common questions which will now incorporate this misstatement evaluation process.